When we talk about financial statement analysis, the first thought that comes to our mind, the first few terms that come to our mind are essentially, the various financial statements like P&L, balance sheet, cash flow, etc. We also look at ratios and how do we calculate it. We would have read a little bit about vertical analysis, horizontal analysis, so on and so forth. There are multiple things that come to our mind in terms of how do we go about calculating ratios. Within ratios, you have profitability ratios, you have stability ratios, debt equity ratios, you have liquidity ratios, you have efficiency ratios. There are 10, different kinds of ratios that you could calculate. The challenge, however, is that there is something that is beyond the textbooks when we look at it, right? And what is that part that is beyond the textbooks, right? So let's first understand the what and why of the problem, and what is it that we are looking at and why are we really looking at. Now, in reality, curriculums or textbooks typically teach us to answer two questions. The first question is what, and the second question is how, right? How do you know what these two questions are? So typically, when you look at a financial statement of a company, and our entire curriculum, education system, and testing mechanism basically tests on these two questions. So the first question would be something like, what is the ratio that talks about indebtedness of a company, right? So probably we'll get a set of answers, and we'll get the answers such as something like debt to equity ratio. Some of us might say interest coverage ratio or whatever, or net debt to EBITDA. There are like 5 or 6 ratios around this, which you could look at, which basically give you a sense of what is the overall debt that a company carries, right? The next question that you typically get in exams or in your test, etc., is how do you calculate it? So you look at the financial statements of a company, and you will take either long-term debt and divide it by equity, or you will take total debt and divide it by equity, or right, or if you're looking at interest coverage ratio, that's basically EBIT by interest, right? And so on and so forth. There could be other definitions that you're looking at, which will come in, right? Our our education system or our testing mechanism stops here, right? So what is taught typically in most of the places is not necessarily ratio analysis, it's ratio calculation. And unfortunately, the real life actually starts beyond this. When you go to a company, in fact, it's not even required to go to a company. If you put the first question and the second question in Google, you will get the exact same answers that we have given here. So we are surely not going to get recruited for calculating the answers of these questions or giving the answers of these questions. In real life, the problem starts beyond this. We are not worried in real life if you don't remember the formula for interest coverage, because Google will tell that to you, right? You can find that out from a textbook. That's not the problem. The problem is, once you have calculated it, can you interpret it, right? And consequently, what is really important is what happens after this. That's primarily one of the reasons of the disconnect between what we learn in our curriculums from textbooks and what the industry tests us on, right? And hence, we are typically, as a set of students across streams, across verticals, we are kind of considered less prepared when we get into the industry, right? Now, what do we need? In the real world, the correct question that we need an answer to is a why, right? Why is a very simple question, but for some reason, our brains are kind of hardwired not to ask this question, right? It is very necessary for us to be able to ask this particular question. And this is a series of questions, essentially. If you can ask a series of whys, that's what will unravel the correct portion, right? There's a common saying about financial statement analysis. And remember, it's not financial statement calculation, or it's not financial statement observation. Most of the times when we calculate ratios, we get statements like sales are growing, right? We get statements like margins or operating margins are declining. This is not analysis. This, what we are seeing, is observation. If you calculate the operating profit margin of a company over 4 years and the margins are declining, there is no point essentially writing that the margins are declining, right? Because that's there to see. The question is, why is it declining, right? Why is it declining for one firm and not for another firm? Why is one firm able to kind of manage its raw material cost better than the other firm? Why is it that some firms do well in downturns and not so well in some others don't do well in downturns? Why does some company have a competitive advantage? You can keep asking a series of whys, and that is what will lead you to good quality analysis. That is what is beyond textbooks. Textbooks don't teach us the problem why. Textbooks basically talk us what and how, and that's where it ends. And real life keeps asking us why, right? So our question earlier, we're not worried about what is the ratio that tells us about debt to equity. We're also not worried about how do you calculate it, because these are available on the web, on the textbooks, etc. What is important is, why is interest coverage important? Why is it more important for some industries than the others? Why is it a problem if it gets over-reported? Why can it get over-reported at times, right? And why does that become a problem essentially, right? If you keep asking these questions, you will eventually at least start interpreting whether there is a sense in some of these and arrive at the correct answer, right? So what we are looking for in financial statement analysis, when we say FSA, or for that matter, any kind of analysis or even valuation for that matter, it is not important to arrive at the correct answer. It is important to ask the right questions. If you ask the right questions, you will probably find an answer to some of those. You'll probably not find an answer to some of those, but you're at least leading in the correct way, right? Only if you ask the right questions are you going to get the right answers, possibly, right? If you don't ask the right questions, there's a problem. So why is interest coverage important, right? It's important because technically when you do EBIT by interest, and you decode this a little bit more, you will realize what kind of a number is good, right? This is essentially telling what is your profit before interest and tax covering your interest by. Let's say there is a company, sales of 1000, right? Costs, all kinds of costs of 900. That gives you an EBIT of 100, correct? Now let's say interest is 80. What is the EBIT by interest? That's 100 by 80. That's 1.25. That's your interest coverage ratio, right? What is left is profit before tax of 20, right? Is this good or bad? It covers its interest. It is able to repay all the interest that is there. But when you look at it, if this cost is fixed, right? Important for some industries more than the others. If this cost is fixed and sales declines by 2%, or let's take 3%, right? Minus 3%. Sales goes to 970, cost is fixed, EBIT is 70, interest cost is fixed because that's a fixed financial cost that you take. You are necessarily in default territory, right? So any industry where you have a bigger fixed cost component, interest coverage assumes a bigger importance than the other industries. If you have variable cost, that's okay because changes in sales will result in changes in costs as well. But if you look at industries like any kind of heavy capital goods kind of industries, or you look at an industry like, let's say, airlines, or you look at industries like hotels, which are heavy fixed cost industries, you would find that interest coverage is more important there, right? Another industry, 1.25 might fly, but in these industries, 1.25 is not good because a 3-4% dip in sales, which can happen anytime, honestly, will essentially push you into default territory. In general, what kind of interest coverage would be good? You would be comfortable at numbers greater than 3. Generally, when you look at interest coverage ratio, you should be comfortable with numbers greater than 3. Anything above 5 is fairly good enough. Anything above 10 is ultra comfortable. You just don't need to worry about it, right? But if you were to kind of bring a broader yardstick on where is the problem, so obviously less than 1 is default. Anything between 1 to 2 is, you have to be careful, right? It's essentially trouble territory, especially for industries where fixed cost is higher, right? That's because of the concept of leverage, operating leverage and financial leverage. If it is greater than 2, then you have to be cautious when you're saying it's greater than 2 but less than 3. Greater than 3 is fine. You're comfortable with greater than 3 as such, right? Now, can it get over-reported at times? Why can it get over-reported? For that, we would want to probably calculate the interest coverage for a few firms and try and understand this and gauge an understanding onto this. There are two parts that we will do here. We'll calculate the interest coverage ratio. We will also calculate what is the cost of debt, right? And then try and understand what's happening. So let's first calculate cost of debt for something like a Tata Steel. So this is the latest annual report of Tata Steel. We can actually look at the numbers and then note down those numbers. So if you look at the total debt that Tata Steel has this year, right? Look at the debt that they have. They have, if you look at the balance sheet, they have 64,000 crore of debt here. That's the long-term borrowings or non-current liabilities. They have nearly 18,000 crore of debt here. That's the short-term or current liabilities, short-term borrowings. And then you have some other financial liabilities, which is 6,000 odd crore. You can get details of these financial liabilities in note number 23. But what you will find is a large part of this is essentially loans that you have taken for the long period, but they are due this year. So you might have taken a loan that is a 5-year loan in 2013, but if it is due this year, technically it will fall under a current liability because that's less than 1 year in duration, but in maturity, but it's essentially a long-term loan. So you don't want to kind of cloud your overall understanding of short-term borrowings. But let's add 64, 18, that's about 82 plus 6 approximately. So that's 88,000 crore of debt approximately, right? This year. If you look at the previous year, that's 64, 15, and about 7. So you're saying about 86,000 crore of debt last year as well. 86 and 88 in the 2 years. And look at the financial cost. So you will see the finance cost is here, right? When you look at the finance cost, you see the finance cost this year is something like 5,000 crore. Last year is 4,221, 4,200 crore, right? Let's note it down. So when we look at Tata Steel for 2017, we are saying debt is about 88,000 crore. 2016, this is about 86,000 crore. The interest or finance cost that they have paid this year is about 5,000 crore. Last year is about 4,200 crore approximately. Correct? Now, first things first, if I have to calculate cost of debt, how do I calculate cost of debt? Can I calculate it by interest divided by the total debt? Approximately, interest by debt should give me this number. So I will calculate that. So we find that cost of debt approximately is in the first year, that 2017 that you see, is probably close to about 5.5%. And here it's close to about 5%, right? Now, the first question that should come to your head is, why does the company get a loan at 5%? Tata Steel is getting a loan at 5%, but Government of India borrows at about 7%, right? Surely Government of India is considered risk-free. That's the most safe or safest security that is available. So if Government of India can borrow at 7%, that's because of their ability to print money that they can borrow at 7%. Why does Tata Steel borrow at 5%? So that's the first why that comes to your mind, right? Why are they borrowing at less than Government of India? Why does someone give them a loan at this price point? Problem one. Problem two is, let's also do this for our other guys, which is Hindalco. And for Hindalco, this year's annual report is not yet out. So we're going to basically go for the annual report of the previous year. Let's look at borrowings, 58,000 crore plus 8,000 crore. And there's some other current liabilities of about 6,900 odd crores, right? So we'll actually just take 58 and 8. So that's about close to about 67,000 crore here. And the last year was 55 plus 11. So 67,000 crore in both the years is the loan that we see. If you look at the interest cost that you find there, where is my interest cost? That's available here. That's the finance cost. 5,000 crore and last year is 4,178 crore, right? 5,000 and 4,178 or approximately 4,200. So here, Hindalco, again, I can write down the numbers. We are saying 2016 and 2015, debt is about 67,000 crores in both the years, 5,000 odd crore here and 4,200 odd crore here as well, correct? And what is the cost of debt? Here, the cost of debt would work out to something like 7%. Here, it would work out to again something like 5.5 to 6% approximately, right? Same question. These are highly leveraged companies. They carry a lot of debt. Technically, they should be riskier. Why is it that someone is lending them money at the rate which is less than the risk-free rate? They surely carry more risk than the risk-free rate, right? Problem one. So we'll try and answer this as we go along, but that's one part of the story that comes out. Let's also calculate the interest coverage ratio, right? So we know the interest, that's 5,000. 400, 4,200, 5,000, 4,200 approximately, right? So I'll write down the interest again here. Tata Steel, 2017, 2016, that's 5,000 and 4,200. And Hindalco, the interest that you see in 2016 and 2015 is approximately 5,000 and 4,200. I'm using approximate numbers. That's the interest, right? Can I find profit before tax? Because if I do profit before tax plus interest, I should get the earnings before interest and tax, PBIT or EBIT, correct? So let's find out the profit before tax. So in the current year, profit before tax is 670. In the previous year, that number was 2280, right? 670, 2280 for Hindalco, correct? That's my Hindalco numbers. So I will go to my numbers and write this as 670 and 2280 approximately. And for something like Tata Steel, we can go to the P&L and look at what is the profit before exceptional items and tax. That's here. That's 6,797 or 6,800 crore. Last year they were actually in losses. So minus 1257, right? 6,800 minus 1250. I'll round it off. So let's write that. Here we are saying 6,800 and minus 1250. So if I add these two and add these two, we will get the EBIT numbers. So this gives me 11,800. This gives me approximately 3,000. This gives me 5,670 and this gives me about 6,480. Correct? Those are the numbers we calculate for EBIT, and that's what we are looking at in terms of our calculations. Now I can divide EBIT by interest. So in this year, this by 5,000 will give me a number of approximately 2.3. Here 3,000 by 4,200 is going to give me 0.7. That's trouble, default essentially. Here this by 5,000 is going to give me about 1.1. That's not too good. And this by 4,200 is going to give me about 1.5. That's still tricky because you don't know what those numbers would be. I mean, technically, could it be higher or could it be lower, right? There's one interesting thing that we have to play out. Now, the first question was, why are they borrowing money or they're getting money at a lower rate? Right? There could be multiple reasons. One of the primary reasons that you will probably find out if you ask this question a little bit, if you probe a little bit further, and that essentially is the fact that this is risk-free rate in INR loans. So maybe it is not INR loans. If it is not INR loans, then this is a foreign currency loan. Technically, you are looking at a foreign debt. If it is a foreign debt, then this carries a currency risk, right? However small it might be, there is a currency risk. And the problem is your interest cost does not include the currency risk. So essentially, when you calculate this number here, you are underestimating the overall interest payment. That's because the interest cost could be lower. And if the currency goes against you, you might end up paying a lot more, right? And there's no free lunch in the world. So technically at some point of time, if everyone decides they're going to borrow from the US at 2%, there is going to be a currency risk that is going to play out at some point of time. We're just not including that here, right? Where is that currency risk? that currency risk most likely would come in other expenses, right? What could that currency risk be? Let's first figure out what is the loan. Is it actually global loans or foreign loans, right? So how do I find what those are? If you go into the annual report, you see these notes. 22 is the note number, page number 300, I'll find this data, right? So if I go to note number 22, I am going to see the data around borrowings, right? So I get a borrowings data that gives me a 64,000 crore kind of a borrowing that's available here. But if you go further and you go further, that's your page. That is important. That's what you're trying to look at in terms of the overall discussion, because out of the total loans that you see, only about 26,000 crore are Indian rupee loans. Everything else is a global currency loan. And if you have a global currency loan, you might have borrowed at 2%, 3%, which ensures that your interest cost is low, but that does not mean that's your entire risk. Your financial risk on this liability could include some of the other issues. So when you look at other expenses, you see that other expenses include foreign exchange gain loss, right? So there's a possibility of a foreign exchange gain loss that is happening here, and that's coming here. That's where part of your interest cost will come, especially if you see a negative movement that is happening on that. So the first adjustment you do here is you have to calculate interest. Either you calculate interest assuming Indian interest rates. That gives you a correct picture of what's happening. Indian interest rates here, anything that is riskier. If you look at Government of India at 7%, Tata Steel cannot get a loan with 88,000 crore of debt at less than 8 to 9%. Assuming 9%, your total interest cost here will be roughly close to, if you assume 9% on 88,000 crore, that's going to be roughly about 8,000 odd crore. That's not 5,000, that should be 8,000. So when you look at this number, it should be 8,000 crore here, and when it is 8,000, your effective calculation becomes 11,800 by 8,000, right? That's your correct number if you assume Indian interest rates, right? Otherwise, you do have to understand that there is always a risk that in one fine year that currency could go from 65 to 75. You borrow $100, that's equal to 6,500, but when you have to repay $100, you have to repay 7,500, right? So what you are saving in terms of your interest today, you will end up paying in terms of a principal change tomorrow. There is a risk of that. You have to be careful of that when you are analyzing companies that are kind of using foreign loan, which tends to underreport the interest cost and hence overreport the interest coverage ratio, right? That's the interest coverage ratio. If I use 8,000 crore as the debt amount, this should have been the interest coverage ratio, and that's less than 1.5. You see this as 2.3, correct? That's the first problem. Problem 2 is a little bit interesting. So let's go to Hindalco again. And when you build these things, you tend to kind of first account for a certain cost in the P&L, and then you go ahead and look at kind of adjusting that to the cash flow, right? So if I show you the cash flows, uh, remember finance cost is a cash from financing activity. So the way this works is you start with profit before tax and you add the finance cost first. Remember this 4178 was the finance cost on the previous page for Hindalco. That's the finance cost for Hindalco. You see this 4178 here. You are essentially adding this 4178 back, and then you will subtract it from your effective number, which is going to be your financing cash flow. So we go to the financing cash flow, and you will find a line item which will say finance cost paid, right? But you see 5,000 crore here. You don't see 4,178 crore here. So that's interesting because the company is accounting for 4,178, but they are paying 5,000. And so that's interesting, right? So now let's go back and check as to where the finance cost is, right? So the finance cost that you see is in note number 33. That's note number 33. So you have to go and check note number 33 for Hindalco and understand where is this coming from. That's the finance cost, right? What's the total interest expense that you see in the previous year? The interest expense is 5,061. Total is about 5,145. And then you find a line item saying less transfer to capital work in progress. And that's about 1,000 crore. What is capital work in progress? What Hindalco is doing is something known as capitalization of interest. What Hindalco is doing is something known as capitalization of interest. And so to that extent, what is important is you look at, so let's say you're building a factory for 1,000 crore and you have taken this 1,000 crore as loan at 10%. What's the interest cost? 100 crore. Now this loan is essentially a sort of a financial raw material. So should you include the fixed assets as 1,000 crore or should you include the fixed assets as 1,100 crore, right? The technical laws of accounting allow you to kind of include the interest cost as a capital expenditure. So while you pay 100, your cash flow will show minus 100. Your P&L will segregate this or depreciate this interest cost over the useful life of the asset, right? So the P&L will basically depreciate it over the useful life of the asset, and that's going to be then, let's say 10 years, it's going to be minus 10, minus 10, minus 10. You paid 100, but you will account for only 10 in that year. And obviously, if you do that, you're going to underreport the interest once again, and consequently overreport the PBT, overreport the interest coverage ratio, right? And that is where the challenge comes in. That is where the essential challenge comes in. And you arrive at the broader problem where interest coverage gets overreported than what it should be. Technically, you should be dividing 6480 by 5,200, which is the number. And that number is about 1.2 then. 1.2 is no longer as good as 1.5. There is trouble that you see there, right? That is the crux of the problem, that all you needed to do is first ask, why is the cost of debt lower? And the second case is, why could a particular, and if you ask that, then you know what are the possibilities of that why. The first possibility is it's a foreign debt. The second possibility is it's capitalizing the debt, right? There could be other possibilities as well, but at this point we're looking at only these two, which tell you that there is a possibility that the interest gets underreported. If the interest gets underreported, that's going to be a problem in the course of an event. When you're looking at interest coverage ratio, you have to adjust this number before you calculate the interest coverage ratio. So first thing is, either you take this as a value and calculate, right? Indian interest rates if it is a foreign loan. Otherwise, if it is not a foreign loan and you think capitalization is happening, you have to use the actual interest outflow in that year. You have to use the actual outflow and not the accounting entry that you see in the P&L. Profit and loss accounts can be opinions based on accounting principles. Cash flow or the notes to accounts is what is going to give you the detail about that specific line item. And it's important to consider that, otherwise you will make a mistake in the overall calculation of this. Any company, lot of debt, especially large capital intensive firms, always check on what is the cost of debt. You'll find this problem with a lot of firms in India, right? So that's basically in terms of the debt point. I have a couple of questions that have come up. I'll quickly address those as well. One of the questions is mathematical in nature, which is saying that if I'm assuming interest to be 8,000, shouldn't EBIT go up? EBIT shouldn't, because EBIT is coming from sales minus costs, and that number should have been 11,800. In the income that they have, in the statement that they've reported, from that they have subtracted 5,000 to get to 6,800. And then we back calculate, right? But if they were reporting the correct number, they would have still arrived at 11,800 sales minus costs. And from that, they would have subtracted 8,000. They should have subtracted 8,000 if this was an Indian loan, right? So EBIT would not increase accordingly, right? The second part of the question is more conceptual in terms of, I see another question that comes in. If the finance cost is increasing due to depreciation, the revenues might also increase because of the same change. They might, right? So if the company is actually exporting a lot of stuff, The argument is that maybe the revenues increase by that amount, but we don't know that as yet, right? We have to analyze for that. If you are sure of the revenues increasing, that's okay. If all your revenues are external in nature, that's absolutely fine. But if they are not, then you be careful about what your costs are. Maybe the costs are also external in nature. Maybe you are importing a lot of stuff to be able to provide what you're providing, right? So in itself, that analysis will have to be done individually for each of the line items. But at this point, obviously, you do need to look at the fact that at least one of these ratios could get distorted if you plainly look at the P&L data points, and that's a problem, right? That's the first example I wanted to kind of take and understand. There's another interesting one which comes up, which is there's a company here, and if you look at what is wrong here, what is wrong here in 2015, right? Look at this carefully. That's the total assets of the company. This is in rupees lakhs. So if I have to convert it to crores, that's about 1,119 crore of total assets. There is a line item called goodwill on consolidation, which is about 856 crore. So nearly 80% of assets are goodwill. Now, what is goodwill? Why is that a problem? Is because goodwill is an intangible asset. How does goodwill come in? Goodwill only comes in if the company that you're looking at has acquired another company at a premium, right? It's an intangible, but that happens when, let's say, your balance sheet has cash of 2,000 that goes out, acquires a company which has fixed assets of 1,000 that comes in. So 2,000 goes out, 1,000 comes in, the balance sheet will not balance. So you will create a goodwill item here of 1,000 and then that will balance the balance sheet, right? The goodwill has to be tested for impairment, which is basically in simple English asking the question, I overpaid 850 crore for acquiring whatever I did. Will someone pay me the same value if I was to sell this asset today? Right? If the answer is no, it needs to be deducted. Now, this is a company which basically in 2007 went ahead and bought these companies. The value of goodwill from 2007 till here was exactly the same. They never tested it, right? And that's a problem because 80% of your assets are goodwill. And we do have the balance sheet of this company. That's a company called Subex. And if you look at the balance sheet here, that's the assets that you're looking at. On the liability side, at least in the last year, what you see is 550 crore of long-term borrowings and nearly 125 crore of short-term borrowings. So nearly 700 crore of loans is what the company runs. 700 crore of loans versus an asset side that if you remove the goodwill, you don't know whether that is worth anything, whether anyone will pay anything for that, right? It could be zero for all you know. So if it is zero, then you're sitting with assets of 1100 minus 850, that's 250 crore. You are practically in a default territory. You will default. You will not be able to repay this loan, right? So what does the company do? Now, interestingly, you find two things. One, this goodwill is going down in subsequent years. So they must be adjusting or removing some part of it, this what is called as impairment. The second thing that you see interestingly is the loan goes off, right? The borrowing amount goes off, becomes zero. 500 crores became zero. Why did 500 crores become zero? Right? That's because this entire thing was a convertible loan. A convertible loan can be converted into equity. So you will see what happens to the total equity share capital. New shares were issued. So the debt got converted to equity. If the debt gets converted to equity, at least the problem of default is taken off the table. You are not going to default because there is very little interest payment that is going to come now, right? And so consequently, at least bankruptcy is out of equation. Can you make losses? You can still make losses, but you probably will survive. So what was essentially an incorrect practice by the firm all these years to keep the goodwill constant has now been rectified by the firm, where the firm has essentially taken equity infusion. It has issued shares to the shareholders. So almost 3 times the number of shares have been issued, such that this debt has gotten wiped out. Once the debt has gotten wiped out, you are looking at a slightly better probability of survival, right? But the thing we are trying to kind of look and assess is that if you ever see goodwill or any intangible asset that is a significantly large proportion of your balance sheet, in fact, anything greater than 20% of assets, right? Greater than 20% of assets as an intangible, especially goodwill, you have to be a little bit careful. You have to assess what is this goodwill for, where is it coming from, and what is exactly happening there. Why isn't the company not removing that, right? Good companies, you will see, will always work in a way that will remove this, right? That's broadly it in terms of our discussion that we have had on a couple of cases or examples that we have seen. So what do we do, right? In terms of our understanding, whenever you're analyzing statements, application of the learning in real life is very, very important. There's no point learning about ratios looking at dummy data. You do need to practice it on live firms, right? And unless you do it on a set of 3, 4, 5 firms, you're never going to get the data around it, right? Whenever you see a ratio or a number that is going up or down, you have to ask a question, why? You'll only be able to ask why is if you do it on a few firms, right? If you do it on two companies in the same sector and see different numbers, then you will start asking why is the profitability more? Why is working capital higher or lower? Why is current ratio higher or lower? And that is what will unravel your understanding about the sector and the company. Plain understanding of what textbook ratios are is not going to take us anywhere, right? It is important to ask the right questions. Just remember this one thing: good analysis is not about arriving at a foolproof thesis. This is a gray area. You never get binary answers to questions, right? You will never be able to arrive at 100% certainty with respect to an equity evaluation. The idea is to ask the correct questions so that at least you probe the correct portions of the statements, and then you arrive at some sort of a conclusion that might make sense, right? Calculating ratios and noting observations is important, but that is not the end goal. That's not where we end our analysis, right? That's where the analysis becomes. In fact, in times to come, calculation of ratios and noting of observations will be automated to a large extent, will not be required for that as such, right? So it's important for us to understand, unless you get your hands dirty on a few companies, it's not going to work well. Annual reports are Bibles for anyone who would want to basically build a career as a financial analyst. Anything to do with equity research, financial analysis, credit analysis, investment banking is going to require us to look at annual reports in detail, right? That's it from me in this particular session.